Hi all, we are third year BCom students of Marian College Kuttikanam, and today we are here to take a session on source of finance as a part of our financial management activity. This video includes a clear introduction to the financial management topic, source of finance, as it demonstrates its relevance through real-life examples and aim to educate viewers about the practical application of source of finance. Finance is essential for starting, running, and expanding a business. Funds can be raised from internal or external sources depending on the company's needs and financial position. So first, I would like to discuss about the internal source of finance. So first internal source of finance which I would like to discuss is retained earnings. So, retained earnings refers to profits earned in the past and not distributed as dividends but kept in the business for future growth. Its uses are it's mainly used for expansion of projects, research and development, purchasing new equipment. Its merits are no repayment required, no interest or ownership dilution, and its limitations are it depends on consistent profitability and it may not be sufficient for large projects. I would also like to explain a real life case study based on this retained earnings. So I would like to take the company Infosys. So I would like to give a background about Infosys. Infosys is one of India's largest IT service companies, consistently generating high profits. Now, how this company used their retained earnings is that Infosys reinvested its profits to expand its global delivery centers. The company also funded research and innovation without taking external loans. Now, its impact is that it helped Infosys grow sustainably and strengthen its market position. And also, investors also benefited from both dividends and company growth. So that's all about my topic. Now, the further topics will be discussed by my team members.
So the second one is about sale of assets. The sale of assets refers to a strategy where the company sells non-essential, underutilized or surplus assets such as land, machinery, building, and equipments to generate immediate cash. This method is often employed when a business is facing a liquidity crisis and needs funds quickly to meet urgent financial obligations like paying off debts, covering operational expenses, and also for managing short-term losses. While it provides fast cash without increasing debt, selling assets is typically a temporary solution that does not asset underlying the problems caused by financial distress. Over-reliance on this approach can weaken a company's long-term operational capacity if essential assets are sold. So, looking to the real-life example, it is about Air India. Before its privatization, Air India was struggling with severe financial problems, operating at significant losses with a negative cash flow. To manage its immediate cash needs, the airline sold unused property such as land and buildings and leased out aircraft that were not being used. So these steps provided short-term liquidity to help pay salaries, settle dues, and cover operating costs. However, this approach was only a temporary fix and did not resolve the fundamental issues of mismanagement and inefficiency within the organization. And also, ultimately, the sale of assets helped Air India survive in the short-term run, but was not enough to secure its long-term financial stability. So that's the end of my topic.
So here we have one of the external source of finance, which is equity shares. In simple words, equity shares are like ownership shares. Companies sell these shares to investors to get money, and in return, the investors become part owners of the company. A good example is Paytm. Paytm got a lot of funds by giving equity shares to big investors like SoftBank and Alibaba. Later, it also launched its IPO. With this money, Paytm was able to expand digital payments all over India. The best part is that the company doesn't have to repay this money immediately like a loan. Instead, the investors share the profits and risks. So basically, equity shares help a company raise funds for growth without the stress of instant repayment.
So next one is about debentures. Debenture simply means these are the long-term debt instruments issued by the company to investors at a fixed rate of interest. They allow companies to raise large amount of capital without diluting ownership. Some of the key features are fixed interest payment, no ownership rights for debenture holders, secured or unsecured depending on company policy, etc. Why companies issue debentures? To finance expansion or infrastructure projects, to avoid giving away equity and control, to access funds at predictable, often lower cost compared to bank loans. Let's see some real life example. Here I took NTPC Limited. NTPC Limited is India's largest power producer, regularly issues debentures to raise funds. For instance, NTPC issued long-term non-converted debentures worth thousands of crores to finance new power plant and renewable energy projects. These debentures gave NTPC access to stable, low-cost capital for large infrastructure development. Instead of selling shares and losing part of the ownership, NTPC borrowed funds from the public at a fixed interest rate. Investors, on the other hand, gained steady returns without being exposed to the risk of equity.
Now, to talk about bank loans. To talk about bank loans, a bank loan is a sum of money which is borrowed from a bank or financial institution that the borrower agrees to repay over a set period, plus interest, which is the cost of borrowing the money. Banks assess the borrower's creditworthiness and financial profile before approving a loan and setting terms like interest rate and repayment schedule. Loans are used by individuals and businesses for various purposes, such as purchasing assets, for various purposes, such as purchasing assets, funding education, or expanding operations. So, how these bank loans work? The borrower applies for a loan, providing personal and financial information. The next is that the bank assesses the borrower's creditworthiness, income, and overall financial situation. If approved, the bank offers a loan agreement that outlines the loan amount, interest rate, repayment period, and the borrower's loan amount along with the interest in monthly installments over the agreed period. Can be for personal needs, asset purchases, education, and for business purposes. Now, to talk about a real life example about Ola Cabs. Ola rapidly expanded its ride-hailing service across India by securing loans for major banks such as HDFC. The borrowed funds were used to purchase vehicles and provide payments to drivers, ensuring fleet availability and smooth operations. This financial strategy allowed Ola to scale quickly across multiple cities while retaining controls over the core business model. Next.
So the next external source of financing is government grants. Basically, this government grants means a financial aid provided by government bodies to support specific sectors or initiatives without repayment. And the main advantage of this source of finance is that there is no repayment or interest and encourages growth and innovation. And one of the challenges that it is complication in the application process. So here we are taking a real life example of Mudra scheme. Mudra stands for Micro Unit Development and Refinance Agency. It is a loan program launched by the Government of India in 2015 under the Pradhan Mantri Mudra Yojana. It is mainly created to support micro and small business that lack collateral or formal credit history. And the loan amount is up to an amount of rupees 10 lakh. And the main target beneficiaries under the scheme is small shop owners, street vendors, food stall, etc. And it also aims at encouraging entrepreneurship and financial inclusion. So we hope that the topic source of finance is clear to all, and that's the end of our presentation. Thank you.